Welcome to Professional Dairy Producers and the Dairy Signal. If you're here to listen to the market update, you are in the right place. And today we bring you Ben Buckner, who's the Chief Grains and Dairy Analyst for Ag Resource Company. And Ben, we're glad to have you back. And I bet you're going to give us good news today. Is that right?
Yeah, Shelly, the pleasure is mine. And I think overall, yeah, the news is pretty good. We want people to be proactive. Something we've talked about in Signal every 2 weeks now for, 3 months. That's still the case. But yeah, the ag markets are changing. Inflationary forecasts are changing as well. And I think we've got to have something go right weather-wise at some part of the world. Southern Hemisphere is next to really break grain markets in bulk. And so we'll cross that bridge when we get to it. But I think we've just got finite supplies. And there's one very important part of this signal, and we'll touch on it a little bit later, but it's just production deficits. I think that is the beginning and end to the grain market outlook.
Awesome. Well, I hope that we'll get people to stay with us for the end because it sounds like the good news is going to be coming. The good news is coming. So I'm going to have you break right into it. But Ben, give us a little brief background. If this is someone's first dairy signal, what's a little bit about Ben Buckner that they need to know as they're listening in?
Sure. So now this is my 18th year in the business. Vast majority of those have been with Ag Resource Company, and Ag Resource Company is they've been around since the late 80s, and we have chosen, for better or worse, we don't trade, we have no brokerage affiliations. It is just advising and helping the world, the US farmer for the most part, kind of navigate these chaotic markets, and that is it. So if we are wrong for any length of time, we go out of business. And so we put a lot of effort into getting these markets correct. And they are very chaotic. And I don't think that's going to end anytime soon. So we are here to help you do that. We've got offices here and in Brazil. We work pretty closely with some companies in Western Europe. And so spend probably cumulatively altogether 400 man hours just getting kind of medium long-term price forecasts correct. And there's a lot of things to talk about and worry about, but we are here so you don't have to worry about any of that. We'll just help you navigate these markets.
I can't imagine anywhere between being a market forecaster and being a weather forecaster, how things can be more volatile. So I'm going to have your head right into it today because I know people are kind of waited with a bated breath to see what the fall is going to look like. And certainly we've had a lot of dynamics from the weather forecast in the Midwest. So let's see how it has had an impact on markets.
Yeah, let's jump into it. And there's a lot to talk about. There's not a lot new to talk about with respect to the US or even global dairy markets, milk specifically, and milk price discovery. Usually the second signal of the month kind of touch on what USDA thinks, how they think things are changing both in the current calendar year and the following calendar year. This was the first report of calendar year 2026 in which they made virtually no changes to US dairy supply and demand over the next 15 months. And it makes sense, all of the kind of nuances of the market, putting together monthly supply and demand, that puzzle, very, very little has changed, including prices. So just right up top from the highest level, cash milk prices, both all milk class three, very little changed. Class three up 10 cents, USDA's forecast for this year, and all milk down 15 cents a hundredweight. All things considered, that is virtually no movement in the USDA's forecast. They did not change US production for 2026. They did not change US exports, domestic demand for 2026. So we're kind of, I think, stuck at these prices. And all things considered, they're not terrible prices, but what we have found is it's difficult for us to identify something that would change milk from these range-bound markets, equilibrium, through the rest of the calendar year. And we will be always on the lookout for production hiccups, production surprises, but even those have gone exactly as expected. So that's the high level message is be prepared for the market to do what it's done the last 2 or 3 weeks for the next 2 or 3 months, I think. So milk prices, very little change. Where margins change, though, I think is going to be in the input cost sector. Feeds especially, fuel probably as well. So that is the margin or the part of the margins that we want to manage pretty actively. But the reason why I don't think there's much change to equilibrium pricing in milk is we haven't gotten anything exciting from supply. And we know that demand for protein is the highest it's ever been. That doesn't change. We're looking at sort of high protein whey concentrate stocks decline, demand's record large. That is still in place. New floors for both cheese and butter consumptions, but we're also outproducing all of that. So the U.S. in the month of June produced 2.3% more milk year over year, and we think that based on cow numbers, what has become a very normal average per cow output on a monthly basis. We're looking at something like 20 billion pounds in July, something like 19.8 billion pounds in June. You can see respectively up 1.8 and 1.4% year over year. So just very, very expected. I do think that on balance, the weight of these supply and production reports does kind of lose its shine maybe beyond the first quarter of 2027. It's one thing to see production growth historically large at 3, 4, 4.5% year over year. Now, that's what really broke the milk market in 2025. Moving forward, I think we're expecting ultimately to get to something like 0.4%, 0.6%. It's still a lot of milk. That is not really insightful, but it's going to kind of lose its luster, how much milk the U.S. is producing. But for the rest of 2026, I think these numbers are going to be pretty large. And I don't think there's a lot to structurally change. Beef crosses, beef cow herd in the U.S. is still fairly tight. We're starting to fix those issues, but still kind of a value part of any dairy operation. So that I think is going to keep milk cow levels very, very robust, very high across the spine of the central U.S. So it's just hard for us to kind of do arithmetic forecast anything less than 1% growth when we think about milk production for the rest of 2026. But like we have said before in the signal, we can all see and feel this. This is not news. The reason why our strategy for a long time has been when you see these periodic rallies, recoveries in the class 3 market, class 4, milk cash prices, those still are to us selling opportunities. And we really want to concentrate on, not really what the market does, cash market, class 3 for the next 90 days. Probably won't do very much at all. It's still that first quarter of the calendar year. And again, I will just reiterate, that is the weakest time of the year for prices and weakest for a reason. We can all see future stocks building of dairy products. Milk production goes fairly swimmingly during the winter months, in the Northern Hemisphere. And on a per day basis, we just consume the least amount of dairy, between January and March. So that market's pretty short-sighted, myopic, trading what's happening this week or this month. And then that's why they tend to break. And the reason that we have that strategy in place, once you see $17.5, $18 Jan, Feb, March class 3, those are places to make some kind of move. And it's not because of the U.S. production rates, the U.S. dairy balance sheet. It's because of what's happening everywhere else on Earth. And again, our chore is to think about or identify what could be changing in the dairy space, not this week or next week, but over the next 3 or 6 months. And that's hard to do. New Zealand, Oceania as a whole, still producing gobs of milk relative to last year. Updated data has New Zealand milk production 275,000 tons. In the month of June, it's up 5%. And Oceania, these very, very rigid seasonal production trends, for all intents and purposes, they produce very little milk during our summer months. That is soon to change. So we have this incredible ascent in Oceania milk production starting in August and especially in September. So that is coming at the market. And I suspect we're going to see ongoing production growth of milk in both Australia and New Zealand. And for context and some background, and we will touch on this as well in a bit, and we all caught wind of Super El Nino, which has yet to peak, still going to strengthen for another 90 days or so. And that typically is very, very bad for Australia. 8 out of 10 years, if El Nino is present in the month of July, we are looking at historic heat and dryness in Australia. For some reason, they have avoided all of that. In fact, if you go back 60 days, it's been a lot wetter than normal and been pretty mild in Australia. So I don't think Oceania milk production is going to be impacted. Oceania is the largest exporter of butter. We need to see some kind of supply disruption there before we can get real bullish of fat in the United States. In Europe as well, and this is something we talked about 2 weeks ago and 4 weeks ago, we were looking at potential lasting contraction in milk production in some of the largest producing countries in Europe, France especially, Spain, as well as the United Kingdom. That was because of drought and record heat. This has been in all kinds of media, what's been happening in Europe. And we saw that happen in May, but production, even in France and even in Spain, despite 103-degree high temperatures, did rebound in the month of June. And now we finally got updated June production data from Europe. and it was 14.3 million tons, up 1.8% from last year. So like the US, these production gains are going to get smaller and smaller because of arithmetic. But I do think we need to see these bars below zero if there is any sort of hope for rallies above and beyond something like $18 in the Class 3 market. And that's not probably going to happen in Europe for the rest of 2026. So these are the reasons why we keep telling dairy producing clients, look at Q1 values, look at margins. That is where we think the risk is, just because of what's happening outside the US. There's a lot of milk being produced, a lot of competition for demand. So we are going to find demand. There's no question about that, but it's at what price is that demand found? And that's something that we have seen in the markets. Think about butter consumption domestically in the US and in the export sector. We're still a pretty sizable net exporter of butter, which is rare historically. There's incredible disappearance rates, but we can see now that that's only happening because the cash market, the butter cash market's sub 160 per pound. So you can't have both high prices and the demand growth we have seen, and that's because of foreign milk production. And this is relatively hot off the presses, and this is something that we focus on. This has been kind of a focal point of kind of measuring fair value of dairy markets in the United States. So the global market, every 2 weeks, we get average auction cheddar, butter, powder, and a total weighted average price. And this, these participants, those active at the global dairy auction, can have been able to see Western European dryness, demand for fat, demand for protein. But this is how the price has been discovered. So this week, the global auctions cheddar price was $1.70 per pound, and that is up 7 cents from 2 weeks ago, but only 7 cents. Still kind of below the long-term price floor that was established prior to the middle part of 2026. So this is, if nothing else, kind of a ceiling to the U.S. cheddar market. The auction's butter price still fairly elevated, but eroding in value. So now that auction price is down to $2.31, that effectively is the floor for cash butter in the United States. Should there be some kind of lasting recovery effort, above these prices, we start to lose what has been pretty incredible export disappearance. But the message here is that the global market is not moving higher, it's moving sideways, or in the case of butter, it's moving lower. So it kind of adds to the weight of the U.S. dairy market. So kind of like Class 3 in the United States, we think that equilibrium has been found. These markets have turned very boring, and prices are more or less stuck. I think the global auction, we will pay attention to the details, whether it's up or down every 2 weeks, but for the most part, we are looking at that average weighted price of all products traded, kind of stuck in a 30-cent range for the next 3, 5, or even 6 months. So again, we're kind of looking for something exciting in the dairy space. It's not bearish. It's hard to be bullish as well. And again, I think equilibrium has been found and we're stuck here. But the risk, as always, is the first quarter of any calendar year. And so we see the same kind of reverse trends in things like corn, wheat, soybeans, even crude oil in normal years has a pretty rigid seasonal trend. And so a lot of people always think that this is the year that seasonal trends will be shrugged off or bucked entirely, but that's rarely the case. And again, I kind of explained why that is, just because supply and demand for that 90-day period between the 1st of June and the end of March is just imbalanced every year. So the market is going to shed premium, we think. We have seen sub $15 Class 3 prices the last 2 years. I don't know if that will be the low this year, but I do think that we won't avoid seasonal price weakness. So thinking about income over feed today, what it looks like Q1 2027, that's the homework that we're going to give you, and that's something to really think about. Beyond that, I think we're kind of back to where the market exists today, ceteris paribus, assuming no black swan events happen, but it is that winter period that we're concerned about milk producing margins. Even thinking about the last couple of years, or the last 5 years, once corn values kind of shot up, input costs have shot up, milk followed, because in a year like 2021 or 2022, we needed milk. We didn't have milk, we didn't have dairy products, so you had to be rewarded. This year, I think milk supply is fairly ample. Balance has been found in supply and demand. So there could be a period of time when the market, philosophically thinking, doesn't really care about milk producing margins. Corn's going to rally, milk may not, and it's not until maybe the second half of 2027 where that has to be reconciled. So again, just kind of hammering in Q1 2027, or if any year, that is the risk that we want to manage in terms of milk pricing. But similar to the dairy signal of early August, I think we want to focus on what is changing in the ag market landscape, and that is grain feed supply and demand, energy supply and demand. And so we've had this list of reasons to be bullish of corn, wheat, soybeans, maybe to a lesser extent protein meal. 2 weeks ago, 4 weeks ago, we kind of had to let the one, I think, potentially bearish input play itself out. We had to give Mother Nature a chance to perform. Could we out yield record soybean demand? Could we not out yield, but could we prevent kind of a major discrepancy between corn production and corn consumption, both in the US and globally? But the runway for that's running out. I think corn yield needs to be debated, but it nearly is what it is. Soybean yields too, we run out of runway to really adjust those numbers on a state basis or nationally beyond the next 2 or 3 weeks. So I think we're kind of losing that bearish side of the feed marketplace. And what we found, what Pro Farmer is finding this week, what Ag Resource found in our tour last week, what crop conditions are telling us, I don't think that is going to be the bearish impetus it was last year and the year before. So now we're just kind of left with this pretty long list of reasons why corn is not expensive today. Soybeans are not expensive, and that starts with the 2 wars ongoing. So I don't think we're going to find a resolution to either of those in the near term, maybe the medium term. We're kind of left with what is going to be the catalyst to resume full activity at the Strait of Hormuz. I don't know what it is today. What will be the catalyst to kind of end fighting between Ukraine and Russia and open up Black Sea shipments, which is incredibly important to the ag space? And I don't know what that is going to be, at least as of today. Crude oil still upside price risk. Biofuel margins are going to be very good. Dairy operations are going to have to compete with ethanol plants for what will be finite corn supplies in 26, 27. The Black Sea, as far as we know, as of this morning, is more or less shut down almost completely. And kind of as an aside or an anecdote, we were finding that Russia had some ports that they rarely use in other places, like the Baltic Sea. They can use some train, rail systems, the Caspian Sea. And so wheat was going up there to the Baltic Sea, and they can kind of squeeze out a little bit of supply. And then last week, Ukraine struck with drones that Baltic Sea port. So there's really nowhere to hide in the Black Sea at the moment. And that's, again, about a third of the world's wheat surplus, maybe 15% of the world's corn surplus that today, at least, the market does not have access to. The bet is if this continues and it's still in place on September 15th, October 15th, I think the market, rightly so, is what's happening today, but can it be fixed at some point in the next month or two? If it is not, I think we're dealing with some pretty dire markets, and importer demand for grain and feed does get funneled away from Ukraine and away from Russia into other origins. One of those origins will be the United States. We still have to deal with historic drought in Europe. It is now starting to rain in France. It is too late to do much beyond maybe improve, cow health for the dairy sector, but corn yields made probably in a lot of places will be cut in half from last year. I think what is new this week and why the ag markets, the grain markets are doing what they're doing is, again, we were going to let Mother Nature try to perform, maybe outperform, limit stocks declines in 26, 27, but that's not the case. So now I think U.S. corn, soybean yield loss on the margin is kind of a new wrinkle to feed market price discovery. And so we have all these investable themes now, one being war in Iran, another being war in Ukraine. U.S. yield loss is kind of a new theme in the market. And so we still have to contend with this, what has become Super El Nino, which does not peak until October, November, and probably lingers around into the first quarter of 2027. And we just don't know what this is going to do to South America. It is already, like it's supposed to, kind of triggering lengthy dryness in Southeast Asia, a major palm oil producer. We're kind of watching West Africa. It's supposed to be dry there. It's starting to turn a little dry. And we're starting to see some impacts in South America. Do we have drought in Brazil for the first time in a few years, or do we not? We don't know that. We will cross that bridge in 45 days or so. But there really can't be any more weather-related production hiccups in the feed space, or else we got some pretty spicy markets in calendar year 2027. We also got rising bond rates, a falling U.S. dollar. Inflation's kind of back on the table. So thinking about even just the speculative community the flow of money. You got wars, world droughts, yield loss, no Black Sea exports, long-term weather phenomenons, now inflation. That all, I think, on balance, does kind of propel money from the equity sector into the raw material sector. That's something that I think we all have to contend with, especially as a dairy operation. So thinking about competition for finite feed supplies, that competition will be higher than it has been the last 2 years, and especially higher than it was last year. And as we debate yields, let us assume that the USDA's previous forecast, 183 bushels an acre, was correct, or they raised yield a little bit for corn in its September report. We've still lost acres enough so that no matter what, we're losing 700 million bushels of corn supply. That is locked in. I don't think we can do anything about that. And we've got wars, droughts, inflation, super El Nino. So just from a very high level, precise price targets, that's something that we'll be working on indefinitely. But I do think higher highs, higher lows in the last 2 years, that is going to define the feed market space. So we're going to jump back to the USDA's August WASDE and, anxiously awaited what would they do with corn yield. We thought that the crops rating, I think at the time, was 61% good or excellent. It's just very hard to match that against production increases in August, or especially yield increases. And that's kind of what we got. So they surprised the market to some extent. They raised acres, but lowered yield, left production unchanged, cut ending stocks for a third consecutive month. And so that's been the trend in the space. We start off, I think in February, we're going to have something like 2 billion bushel of corn carryover in 26, 27. It was 1.9, it was 1.8, now it's 1.65. What we're finding with yields, I think, is that there is room to lower USDA's national corn yield forecast, another 1, 2, maybe 3 bushels per acre. It's going to be hard to ration consumption or change the flow of corn globally, which we'll touch on in a bit. So I think any production loss at this point, for the most part, is going to come out of end stocks. And so you're kind of getting to the point on this supply and demand relative to price curve, and that starting prices forecasts are starting to go up at an accelerating rate. And again, that is a concern for the dairy operation. This is kind of what it looks like. Generally speaking, I think one of the themes in the grain space, especially since we had to deal with, crippling drought in plains, the loss of 12 million tons of U.S. wheat production, European wheat production was down something like 15 million tons. And so the general theme in the grain space has just been the oversupply of last year, which was very real. It's been kind of erased and wiped out completely in one crop year. So fair value, the market will determine that every day, but these are tightening grain balance sheets. They're not loosening. What happens in South America is a big deal and a big question that we've got over the next 6 months. So what I think is we're all preparing for kind of even higher prices is one, 8 of the last 10 years, Chicago corn, for example, has bottomed in the month of August. And so this is the time of year when I think actual physical supplies and perceived physical supplies are at their largest. And we know that we can quantify South American corn supplies are at their peak maybe this week, and yet the market's doing what it's doing. We've got, probably bulk corn harvesting starting in Arkansas, moving into Tennessee and Kentucky within the next 3 weeks, and the market's still doing what it's doing. So this is what the market is doing, the feed market. In August, what does happen December, Jan, Feb, March, and April when physical supplies globally are at their tightest? So again, something to think about. But anyway, with respect to changes in the U.S. corn balance sheet, kind of in the medium term, it's crop ratings continuing to sag, 60% good to excellent, it's pretty middling. Excluding outright drought years, this is at the low end of the last 2 decades. And of course, the core of the issue has been drought, maybe west of Iowa, which has not been solved or mitigated. We have seen no improvement in crop health, whether it's USDA's crop rating or actual vegetation health, since the early part of August. But even in places like Illinois and Michigan, we're just seeing crops not rated very good. And this does not give you precise yield or production targets, but I do think it's telling us something. So this is where we've got this kind of surface level cursory information from the USDA every week. And now we go into the fields like we all do first third of August. And what we're finding has been pretty disappointing, especially compared to last year. So what you are looking at here is at least the last 5 years of Ag Resources crop tour, which is pretty extensive, but confined to Iowa and Illinois. So, minimum 60 samples, spans 3 to 4 days. We keep this data pretty organized and rigid, and we go to about the same fields every year. Our yield forecasts are not going to be correct. We're not going to match the USDA. That's not really what we're concerned about. Even our year-over-year yield changes will not match USDA's, but I wanted to present just our findings. And so we kind of caught wind through some clients of ours that people pulling ears and just finding that the ears were pretty small, maybe didn't fill out, which didn't have a lot of girth, and overall plant populations were down year over year. So we're kind of looking at the arithmetic and just kind of getting to ear population in Iowa, for example, down 2,500 from last year. So that's already kind of weakening the base of production growth. We found grain length down, kernel rows down slightly, kernels per ear down slightly. And so our yield indicator, or our yield estimate based on these numbers for Iowa, is 206 bushels an acre. Again, that's not going to be correct. But look at how it compares really to the last 5 years, especially to last year. So Iowa's corn yield, I think Pro Farmer would confirm this, is going to be down from last year. The USDA in its current by-state yield forecast has Iowa up 4 bushels an acre at a record 216. So that's a pretty sizable swing when we think about corn supply availability, at and after harvest. Illinois, not as dramatic, but still similar. So just the data that we keep, we're finding reduced populations, reduced grain length, et cetera. All right, Illinois yields down, almost 25, maybe 30 bushels an acre from last year. So that's, not going to be precise, but something in the ballpark. Illinois' corn yield is going to be down 5-6% from last year. I think the USDA has them down 2 bushels an acre from last year. So as the USDA starts compiling its by-state numbers in September and October, I think there are going to be some pretty big swings. And that is what gets you to a national yield, something like, we're at 178 today officially at AgResource, but we can't dismiss the possibility for something like 176 and a half, 177, which all things considered would still be the 3rd or 4th highest yield ever. Just not going to be enough to kind of offset this pretty incredible corn demand that we found. We're also dealing with some other things. This comes from a client kind of center west Minnesota. And you can see this deep red along the border of North Dakota and Minnesota, rainfall deficits from May 1st, up to 8.5 inches. For all intents and purposes, it has not rained in this region since July 1st, and of course, this is negatively impacting corn. So you're going in some places from APH of 197 to broad estimates late July 160, and now we're thinking 130 or 140. You're seeing actual ears pulled from center west Minnesota, and so pollination, drought stress, et cetera. Minnesota's, I think, going to be kind of a mix between very, very good crops and these very, very bad crops. But the USDA, again, thinking about their current matrix, has Minnesota's corn yield statewide at 197 bushels an acre. And that's down 4 from last year's all-time record. Probably got to deepen those cuts in Minnesota. So all this starts to add up. And this is where kind of the arithmetic comes into play. So we have lowered our yield from USDA's 180.7 to 178. It's very hard for us to cut demand. We will cut a little bit of feed and residual use. That is kind of a function of production anyway. We will trim U.S. corn exports because there is a lot of corn in Argentina, at least at the moment. So I don't think there's much we can do with ethanol. And so suddenly we are down to 1.4 billion bushel in stocks and a stocks to use, stocks as a percent of consumption, of just 8.6%. Price models would model out to an average cash price at $5.90 per bushel, but let us be very conservative and say it's pretty easily to model this out to a cash price, nationwide average. Accounts for a majority of corn being sold at harvest at $5 per bushel. That is where the futures market exists today. That by itself, I think, tells us there's still many dimes of upside risk in the corn market. And this is the slide I was telling everyone about, just kind of the beginning and end of corn markets over the next 9 to maybe 10 or 12 months. Production deficits. So the USDA using 180.5 bushel corn yield. Trend yield in South America next year is already projecting a 17 million ton production deficit, production less consumption. So using our U.S. corn yield, we're trimming European corn production a little bit. And I don't think that's a secret or insightful, but we widen this out to 26 million tons or just over 1 billion bushels. So this is important. Notice that this doesn't happen very often. We did not actually have a global corn production deficit in 2012 because what we lost was more than picked up in South America. Once we have production deficits, that tends to foreshadow kind of lasting upside momentum in the feed space. And so, again, this is the risk. And we can debate US corn yield. We can debate what the final crop size of corn is in Europe or how Mother Nature performs in South America between, December and April of next year, but you're locked into some kind of deficit. I don't think we can make up 17 million tons of production with adjusting US corn yield by 1 or 2 bushels an acre, or even assuming perfect weather in South America from now until April 30th, 2027. So this defines the market, the feed space. And just for context, this is the price model that we looked at. And it's not perfect once you do start to get tightening balance sheets, but thinking about the risk of cash prices, especially after harvest, non-zero chance of 650. And I think this just kind of sets the stage for what happens weather-wise in the Southern Hemisphere. If everything is perfect, maybe we kind of lose some upside momentum here. Cash price is $5. That still generally fits. If it's not perfect, we were back to where we were between 2020 and 2023. So it's kind of painting the picture of risk. Where does it lie? The U.S. growing season is nearly over. We think it lies to the upside. And why I think it's hard to really change demand for corn between now and maybe next spring or summer is there's not a lot of competition for consumption. So one of the features, and this kind of goes to everything this year being the opposite of last year. Last year, we were talking about how much sorghum the U.S. had on hand, how perfect weather was, how big yields were. Well, that has been reversed in one crop year. Drought in Kansas, drought in Texas, drought in Oklahoma and Colorado. The crop today, sorghum rated 68%, 28% good to excellence. That is historically low. A third of the U.S. sorghum crop is rated poor or very poor. And so I think we're going to lose something like 45 or 50 million bushels of production pretty easily. I'm sorry, 140 or 150 million bushels. We were using a lot of sorghum in the feed space a year ago. It was very cheap. I think basis weakness kind of peaked at $1.30 below Chicago Board of Trade. There were a few days last autumn where sorghum was $2.85 per bushel, basically zero. That is going to flip on its head, I think, pretty considerably after we get through harvest this year. I think, too, ultimately at ethanol plants in Texas and Kansas, we are going to use 125 million bushels of sorghum for ethanol production. And you could see on most months that this was displacing something like 12 or 15 million bushels of corn consumption. Well, this is going to go away after, I would say, October or November. And we're thinking that because simply we've lost U.S. sorghum production, we've got to add 60, 70, maybe 80 million bushels to the U.S. corn ethanol grind. So demand growth in the domestic sector is probable. You never get detailed information on feed, but I think we're going to use probably something like an additional 75, 100 million bushels of corn to actually be fed to livestock across the southern and central plains this year because we don't have the sorghum supplies. And in any case, even in years of geopolitical calm, weather normalcy, like I mentioned before, 8 out of the last 10 years, Chicago corn's bottomed in August. And that makes sense. We have gone through the growing season. We more or less know what we're dealing with in terms of replenishing the cash pipeline with new crop supplies. And so it's what's next. Now it's, I think, end users getting their hands on what exists, because the next chance of supply replenishment in the world corn market does not occur until June, July, when we start to gather South American crops. So between August, June, July, you tend to have an upward movement in price discovery. So I think that volatility is going to be elevated. That is a feature of bull markets and markets that are tightly supplied. But if you squint your eyes and just look at these rigid seasonal trends, you kind of know when to buy corn and when to sell corn. And that's why we kind of started this out with. If the corn market's doing what it's doing in the first half of August, where will corn prices be, some point between February and May, assuming normal South American weather? So again, I think this is kind of our guiding light here. Does a dairy operation need to lock in feed from now till late winter, spring? I think the answer always is yes, but especially this year because there's a lot of risk. We've lost Black Sea supplies, Super El Nino, et cetera. We're not really sure how tight it's tight when we think about balance sheet changes over the next 6 months. And just as a snapshot, this is from midday today, just what's happening in the Black Sea. Attacks almost on a daily basis. And what we have found with some of our closest friends, people we rely on for the best information within Russia, is that it all comes down to one, crews not wanting to go into war zones. But even if there were very brave crews, the insurance companies have left because of the reliable nature of drone attacks from both sides. Insurance companies have said we are no longer insuring vessels, at least at this very moment. So you can see here, these just kind of filtered for cargo vessels, green little boats moving around the southern Black Sea. But what I've highlighted is where basically the entirety of Ukrainian and Russian ag products originate from. And there are no green dots here. So the Black Sea essentially shuttered at the moment. They are supposed to export a combined 28 million tons of corn and a combined 65 million tons of wheat. Will those numbers get cut in half over the next 12 months? That, I think, is the game that wheat and corn are playing. And I think that risk is very real because, again, we're not sure exactly what the catalyst will be to solve these issues, at least for the next month. Maybe it's the next 6 months. And so we kind of got put together this puzzle. We're jumping into the weeds of the wheat market, but I wanted to kind of show you the risk that lie ahead for a market like wheat, its impact on corn, and so its impact on corn in the upper Midwest cash market. So wheat bottleneck, logistical snarls piling up at elevators within Russia. The market there has collapsed. In some places of the central Russian region, wheat is down to $3.40 per bushel. It is quoted into the world market at $210 per ton. That is something like $2 below German and US wheat. So it looks very, very attractive. Not very much of that wheat can actually be purchased. And so I wanted to show this because we have found that Russia is working as hard as it can to find all possible alternative outlets. Maybe it can use the Caspian Sea to ship wheat and corn and oilseeds to Iran, or to kind of the southern part of Asia, satellite countries, former Soviet Union. It was getting a little bit out of the Baltic Sea, but this is what we're left with. So it is something like 2 or 2.5 million tons per month. Compared to normal, this is about half or less than half. So I want to think about kind of set the stage. We would not be surprised if in the next 30 or 45 days, the wheat market looks similar to the way it looked in 2022 when Russia initially invaded Ukraine. So for now, we had just incredibly large wheat harvests in the largest importing regions like Morocco and Algeria, the Middle East. Turkey had the largest crop they've ever harvested on record. They're typically a very sizable wheat importer. And so they've gotten by on domestic stores for now. They're seeing the wheat market go up, but then they say, we don't want to buy it. We have enough. We're not part of this game yet. That starts to change September, October. World wheat trade can be pretty unremarkable. People kind of blasé about forward coverage, August, July. That starts to change as you get to the middle part of autumn. Even these countries that had record production are going to have to come back to the world market at some point in autumn. Can they buy Russian wheat? Or do they have to buy, wheat from Denmark or Germany or the United States for the first time ever? That is, I think, what's coming in the next month and a half or so, maybe 2 months, unless there's some kind of third-party diplomatic effort. And maybe wheat at $7 per bushel is not expensive enough to trigger that kind of action. So we did ultimately get a Black Sea corridor established second half of 2022 because wheat was at $12 per bushel. Food security, poverty, et cetera, those were all very, very big issues. And so the UN and Turkey got involved. And then we started to kind of open the valve. Russian grain, Ukrainian grain came out into the world market. But you can see what I've highlighted in red here is that this is what happened before that Black Sea export corridor was established. Insurance companies not insuring vessels, actual attacks happening. This is kind of where we are on the timeline. So do we or do we not get involvement from the United Nations again? And if we don't, we're kind of stuck with Ukraine, Russian ag export capacity, half of what it should be and half of normal. And I also wanted to say, even to the protein meal markets, to some extent, the veg oil markets, even the soybean market, we have been hyper-focused on wheat maybe to a lesser extent corn because of what is happening between Ukraine and Russia. But, lo and behold, Russia and Ukraine are supposed to, in the USDA's trade matrix, export a record 13.6 million tons of vegetable oil. A lot of this is sunseed oil to neighboring countries, but I don't think a lot of this can come out into the market unless this war is resolved. Even oil seeds, actual raw materials, a combined 8 million tons of soybeans, canola, and sunseed, and that is up on last year. I don't think anyone expects Ukrainian oilseed, Russian oilseed exports to be anywhere close to last year unless there is resolution. And I would say that half of this are soybean exports. So they're not a big soybean exporter, but of their total oilseed, soybeans are about half. So I think that's a big deal. So if you were to replace just 1 million tons of what we should get from Ukraine and Russia in the soybean market with U.S. soybeans, that adds 35 million bushels to exports. And that is not in anyone's trade matrix currently. So this is kind of impacting the ag space on the whole. So we want to be prepared for more geopolitical risk premium to be added to these markets. Corn export demand's very healthy. Even just last week, we physically shipped 75 million bushels of corn to all destinations. The same week a year ago, that number was 41 million bushels. So I don't think we are at this point rationing demand in any sector for corn, not at $5. So thinking about this tightening balance sheet, what does the market look like 6 months or 7 months from now, can get very spicy. There is competition from Argentina. They had, if you remember, just this incredibly large corn crop. They have got a record surplus, beats every year. I think the most recent year, they were able to export 40 million tons of corn. This year it'll be 43 million tons. So they will be providing competition for the short term. But South American corn exports and Argentine corn exports do, as you can see, peak in July. So I think since South American corn exports peak in July, the burden placed upon trade flows is going to be getting higher. So you have been able to get a lot of corn from Argentina. That has been kind of a relief to the U.S. corn balance sheet. But that starts to change as you get to September and October. You can get a lot more corn from Argentina than you could last year. But overall, it's not going to be nearly as much as it was in the first half of the calendar year. So I do think that importer demand, for a lot of reasons, including war in Ukraine and Russia, does get funneled back to the U.S. space. And at $5 December corn, ethanol margins are still quite profitable. And we would plug into our grids. I still think at a representative plant in Iowa, revenue today is above all costs, even if it's just a penny a gallon. So all we need to do is beat variable cost. But if we're above all costs, even by a penny a gallon, you're still maximizing ethanol production. And the ethanol market's getting stronger. It's not getting weaker. And I think this has been dislodged from crude. But if crude's upside is back to $90 or $95 a barrel, if because we've lost refining capacity in the United States and elsewhere, gasoline goes back to $3.50, in the futures market, these margins get even better. So end user margins are telling us we're not slowing corn demand today at $5. If gasoline prices stay where they are, ethanol prices stay where they are, and DDG prices don't move, I think you do start to stress ethanol production margins at $5.40 December Chicago corn, but not until then. So that's kind of your initial target, I think, or something to think about. That is the room that exists for upside potential based on end user margins. And kind of lastly, El Nino. Again, I think El Nino's issue to us is it is going to be the strongest in recorded history, which goes back to 1950 only. But we don't have any analog year. So we generally know that El Nino is wet in the United States for the most part, very good in Argentina, mixed in Brazil, very bad in Australia, Southeast Asia, and West Africa. So that's the starting point. But if you've got temperatures in this little sliver of the Pacific Ocean, like 4 degrees Celsius above normal, that's something we haven't seen before. So we just don't know what this is going to do to Southern Hemisphere production. We do have sort of a template. And so the way we would couch forward weather risks for soybeans and corn specifically is El Nino, when it is present, now or in January especially, it does not foreshadow issues in Brazil. It doesn't guarantee yield loss. But what you're looking at here is Brazilian soybean yields relative to trend. The red highlighted years are years that El Nino was present in January. I think what it does do is it raises the odds of regional dryness, delayed arrival of the monsoon season. And so when we have seen pretty big yield loss or weather challenges, El Nino is typically present. So we're kind of on heightened alert. No alarm bells. I think we've got until September 30th, maybe October 5th for the monsoon to kick in Brazil. But once you get to the middle of September and it's not raining in Mato Grosso, Brazil, I think the alarm bells will start to sound because planting dates determine harvest dates. That those determine when they can plant winter corn, which goes a long way in determining winter corn yield potential. So we need very, very big crops out of South America. Does El Nino throw a wrench into this? That is going to be the next question. And I think the question will start to be answered in 30 or 40 days. Input cost, fuel, we think fuel costs will be elevated, diesel especially, kind of the distillate markets. We've been able to sell a lot of crude out of the U.S. for strategic reserve for better or worse, but that is kind of tempered real upside strength in the crude oil market. Thinking about the first part of the U.S.'s involvement in Iran, the best crude could do was $120 a barrel. That kind of shocks people. 180, 200, that was the expectation. But the market is what the market is. But I do think we're kind of emerging this concern in gasoline, diesel, because we've lost a lot of refining capacity in the Middle East. How quickly can that be repaired? Motor gasoline stocks are down 6% from last year, tend to go lower into kind of the holiday season. None of the energy markets in the U.S. are terribly well supplied, so it's going to take something to kind of rejuvenate this. I'm not sure if any of this really changes for the rest of 2026, so we're concerned fuel costs stay elevated. Kind of lastly, looking at the bond market, looking at the dollar index and this new, for now, modest bear trend, but I do think that there is some reason for momentum to kind of weaken the US dollar, be concerned about bond prices, general inflation. That, like in 2020, 21, did attract money into the raw material space. And that probably includes milk, beef, cattle across the board, but certainly will include feedstuffs and energy as well. So again, from the highest level, we are neutral dairy, but kind of bullish everything else. And so the risk to the dairy operation is managing those margins. So be very proactive about that. We like buying feed even today. So as always, a lot of information. Here is our contact info. If you have questions now or at any point in the future, please don't hesitate to reach out.
And now is a great time to be asking those questions. You got Ben right here at your fingertips. If you're recording live with us today, we would love to have those questions. We'll give just a moment. So Ben, as a dairy farmer, what are you most excited about right now? We've got markets looking a little, and we can book some feed, but what are you most excited about looking into the future?
I think thinking about the next 18 months, I do think it will have been many years, but the sort of supply side weight starts to get eliminated. And I guess too, I think let's call it 17 and a half class 3 is a little higher than we thought we would be today, 60 days ago. We've had a lot of things thrown at the market. We've talked foreign production being very good, Europe kind of weathering drought. Domestic cheese consumption has failed to grow in the last 3 months, and yet here we are. We're finding export demand. Fat demand's very good. We're producing lots of butter. So I think that this kind of tells us that there is this base of consumption that exists globally, and that's very exciting. That doesn't change. We all can see and feel the protein story everywhere we go. Dairy is going to be a part of that. And so if we can start to get, by summer 2027, European milk production growth ends, maybe New Zealand milk production growth ends. And all of a sudden, we're kind of back to talking about we have this hole in the world market space. The US is going to be the one to fill that. So I think that just very hard for us to be overly bearish of milk prices because of fat and especially because of protein demand. So I think that if we can kind of weather what we think will be higher feed costs, the future looks pretty bright relative to kind of pre-2020.
So recently with Tyson closing some more plants, the volatility on the beef side, looking long term, how do you see that playing out? And what do you think that'll mean to our call cow numbers and some of our stocks of beef, and how will that impact the markets?
We think that the high end cattle prices is in, and of course at $250 a hundredweight, that's an easy call to make. and the Tyson closures are unwanted, I don't think it will have an impact on things over the next 12 months. But the research that we have done is for a lot of reasons, whether it's even modestly increasing cow numbers, on feed numbers. I suppose we're going to start cross-border trade with Mexico at the end of this month. We'll see if that's successful, but it probably expands. The beef market itself probably loses a little bit of value on balance, maybe indefinitely. And seasonal trends are bearish beef after August anyway, so none of that's very new.
Right.
But the cattle supply issue itself, we think will be a little more challenging to solve. I think we still have to contend with potential for winter storms. El Nino, typically very wet in the winter in the United States. We still have pretty major drought kind of west of Iowa. I think that's going to be an issue. So I think that cow numbers are not going to be much changed 12 months from now. And I think the cattle price, while the peak is in, I think they stay fairly elevated. Maybe we do solve this calendar year 2027 or the second half of 2027. But to us, we're not willing to embrace some kind of bearish cattle price outlook yet, though beef may be a little more plentifully supplied at some point next spring.
Okay. All right, you heard it here on the Dairy Signal. That's what we're thinking about. We're thinking about a lot of changes that have happened because of wars and weather, as always. And if those of us who live in the dairy world, we're pretty much used to the volatility that goes up and down. And with that volatility, there's always opportunity, which Ben did a great job today of summarizing and pointing out to us. We're going to be looking forward to the weekend here at Professional Dairy Producers. But as we move forward, we wish all of you, as you're thinking heavily into harvest season and the start of school, be safe on those roads, be watching for people, and make sure that you have a great start of next week. We'll see you back here on the Dairy Signal, and a hearty thank you to Ben Buckner and our friends at Ag Source or Ag Resource. And with that, signing out from Professional Dairy Producers, make today your absolutely very best.